Own nothing. Control everything.
Have you ever wondered how the ultra-wealthy sidestep billions in taxes without breaking the law? The answer lies in a mechanism so invisible that it moves trillions through estates quietly, almost like a ghost in the financial machine. Step-up in basis is the loophole that the 0.01% use to erase decades of capital gains. Stick around, because by the end of this video, you'll see how one rule quietly shifts the balance of wealth, silently fueling a hidden empire. Imagine owning a valuable painting, an investment property, or shares in a company. Over decades, their value skyrockets. Normally, selling these assets triggers capital gains taxes. The government claims a portion of your profit. But here's where the phantom appears. When these assets pass to heirs through inheritance, the law allows their basis to be stepped up to the asset's market value at the time of death. Step up in basis means that the appreciation accumulated over decades vanishes for tax purposes. A family could inherit a stock purchased for $1 million that's now worth $50 million. Thanks to this rule, the heir could sell it immediately and pay virtually zero capital gains tax. The invisible engine behind this is simple yet profound. The unrealized gains disappear on paper, resetting the tax clock to zero. It's not just a small loophole, it's a silent wealth escalator. Over generations, step-up in basis compounds, letting fortunes pass untouched by capital gains taxes. This is why experts call it 100 billion or more phantom in the US tax system. Understanding this concept is not just about numbers, it's about seeing the architecture of wealth, the hidden scaffolding that allows assets to flow uninterrupted across generations, untaxed and unnoticed. By grasping this mechanism, you'll start to see the tax code not as a set of rules, but as a map of power, privilege, and invisible pathways that separate the ultra-rich from the rest. Step 1. Asset appreciation. The wealthy acquire assets, real estate, stocks, or businesses that steadily increase in value over time. Picture a stock portfolio quietly swelling while the original purchase price remains fixed in the books. The difference between the purchase price and current market value is unrealized capital gains. Here, nothing is taxed yet, but the potential tax liability looms like a shadow. Step 2. Transfer through inheritance. Upon the owner's death, these assets pass to heirs. Instead of taxing the gains accumulated over decades, the law allows the asset's basis to be reset to its current market value at the time of death. Imagine drawing a line through history, erasing all previous gains. The capital gains tax liability is wiped clean, and heirs inherit an asset ready to sell without tax consequences. Step 3. Immediate or delayed liquidation. Heirs now face a choice: sell immediately or hold. If sold, the tax bill is minimal or zero. If held, the asset continues appreciating, compounding wealth tax-free until the next generation. This cycle can repeat indefinitely, each iteration silently magnifying the family fortune. Think of step-up in basis as a financial teleportation device. Decades of unrealized gains vanish at death, reappearing as a clean slate for heirs. The process is legal, straightforward, and chillingly effective. Few outside the ultra-wealthy ever see its scale, but its impact quietly reshapes the landscape of wealth, creating generations of advantage invisible to ordinary taxpayers. The benefits are striking. First, tax erasure. Multi-million or even billion-dollar gains vanish instantly for heirs. Imagine a $50 million investment sold with near zero tax. This is the phantom in action. Second, wealth preservation. Families can pass down assets intact, maintaining intergenerational fortunes without gradual erosion by taxes. Think of it as a bridge carrying decades of wealth across generations, unscathed. Third, compounding advantage. Step-up in basis doesn't just erase past gains, it accelerates future growth.
As it rolls,
Assets
the snowball
continue
effect takes
appreciating,
hold,
now with a
gathering gold
zeroed
dust
basis,
and growing
amplifying the
exponentially in its
compounding
wake.
effect. A $50 million stock today could become $200 million in a couple of decades, again, largely untaxed. Fourth, legal shield. Unlike offshore tax shelters or aggressive schemes, this is fully legal. It's embedded in the U.S. tax code, giving the ultra-rich a sanctioned avenue to avoid taxes without scrutiny or controversy. Fifth, invisible mechanism. Perhaps most importantly, it operates quietly, under the radar. Ordinary taxpayers rarely see it in action, while the ultra-rich exploit it as a default wealth-preserving strategy.
Step-up in basis stands apart from other tax mitigation strategies. Unlike trusts, charitable donations, or offshore accounts, it requires no complex paperwork, no regulatory gymnastics, no aggressive planning. Other methods may shield portions of wealth, but often attract scrutiny, audits, or public controversy. Consider gifting assets during life. While this can reduce estate taxes, it triggers immediate capital gains for the recipient, eroding value. Selling assets before death incurs taxes on gains, permanently reducing the estate. Step-up in basis, by contrast, eliminates the tax burden almost entirely, allowing full transmission of appreciation without touching the treasury. Even compared to charitable remainder trusts or family-limited partnerships, the simplicity is striking. There's no annual reporting or valuation disputes, just a legal reset at death. The key difference is scale. Step-up in basis can quietly erase millions, even billions across generations, while other strategies provide incremental relief. In essence, it's the stealth jet of wealth preservation. Invisible, fast, and extraordinarily efficient. Step-up in basis is inherently designed for ultra-high net worth families. If your estate contains appreciating assets, real estate, stocks, private businesses, you already qualify for this silent advantage. Families with multi-generational wealth, concentrated portfolios, or holdings in long-term investments stand to gain the most. However, it's irrelevant for those without substantial unrealized gains or who rely on liquid income. Ordinary investors, retirees with modest savings, or those holding primarily cash and retirement accounts will see little to no benefit. Understanding its scope is crucial. It's a mechanism of preservation, not accumulation. Recognizing who can leverage it and who cannot is part of seeing the tax code as a map of privilege rather than a universal tool. Step-up in basis is automatic. Heirs do not need to apply for it, but strategic awareness matters. Step 1. Inventory assets. Identify holdings that have appreciated substantially over decades. Real estate, stocks, collectibles, businesses. Knowing the scale of unrealized gains informs estate planning. Step 2. Maintain records. Documentation of original purchase price and dates is essential. Accurate records ensure the basis is correctly stepped up, avoiding disputes or errors. Step 3. Consider timing. While the rule triggers at death, planning around asset location and legal jurisdiction can maximize the benefit. Certain states impose additional estate or inheritance taxes, so strategic allocation matters. Step 4. Consult professionals. Lawyers and financial advisors familiar with multi-generational planning can structure holdings to fully leverage step-up in basis. Though the process is passive, guidance ensures no overlooked details erode its impact. Think of these steps as preparing a map for heirs. The rule works silently, but clarity ensures it delivers maximum advantage. Step-up in basis is not without limits. Federal law caps estate taxation only above thresholds. State-level estate or inheritance taxes may apply. Certain asset types, like retirement accounts, do not benefit directly, and assets transferred before death may trigger gains. The largest cost is opportunity cost. Assets must remain in the estate until death. Early sale forfeits the stealth benefit. There's also moral scrutiny. Critics argue it deepens wealth inequality, privileging those with the foresight to hold appreciating assets. Real-world examples illustrate the scale. Consider a family owning a tech company purchased for $2 million in the 1980s. By 2020, its value exceeds $500 million. When transferred at death, heirs could sell immediately, paying negligible capital gains tax, preserving the full fortune. Multiply this across hundreds of similar estates, and the federal government loses tens of billions annually. A phantom tax gap invisible to ordinary citizens. Even in public discourse, the loophole fuels debate. Some propose capping step-up in basis, or taxing unrealized gains at death. Until then, it remains a quietly powerful engine for wealth preservation, illustrating how legal structures can channel vast sums with zero friction while shaping the very landscape of generational wealth. Step-up in basis is more than a tax rule. It's a lens into the invisible architecture of wealth. By erasing decades of gains, it quietly fortifies generational fortunes, giving the ultra-rich an edge most will never see. Understanding it is understanding power itself, the silent scaffolding of inequality. If this perspective changed how you see the tax code, hit subscribe and comment below. Share your thoughts on how hidden rules shape fortunes while remaining invisible to the rest of us.